Good morning, ladies and gentlemen, and welcome to the FLOWTECH FLUIDPOWER PLC half-year results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and will publish those responses where it's appropriate to do so on the Investor Meet Company platform. Before we begin, we would just like to submit the following poll, and if you could give that your kind attention, I'm sure the company would be most grateful. And I would now like to hand you over to the executive management team from FLOWTECH FLUIDPOWER PLC. Mike, good morning, sir.
Thank you, Jake, and good morning, everybody. Thank you for joining us today for the FLOWTECH half-year results presentation 2025. Just as by way of introduction, and for those of you that are joining us for the first time and joining the FLOWTECH story for the first time, I'm Mike England, CEO. I've been with the business a little over 2 years, joined part of this really exciting transformation journey that we're on, and the formation of a new highly energized team. Prior to joining FLOWTECH, I was a little over 7 years with RS Group, so the FTSE 250 now business. So really exciting career there, and learning quite a lot also about the digital aspects of B2B industrial distribution. Prior to that, I was with FTSE 250 Group Brammer PLC. Prior to that, I was with Rexel Group, and I was an engineer from a degree side prior to that. So just a little under 30 years in industrial products and service distribution. So a fair bit of experience to bring to bear here. So looking forward to giving you updates around our trading highlights today, and giving you some progress reports on the transformation journey that we're on. Russ, just a little bit on yourself.
Yeah, morning everybody. Russell Cash. Time flies, doesn't it? I joined the business at the back end of 2018, when the world was a fairly stable place, wasn't it? The back end of 2018. My background prior to joining FLOWTECH was in the world of turnaround and restructuring, which actually came in quite handy when the world became a less stable place, reference to COVID-19, and came in quite handy actually with some of the recent acquisitions that we've progressed and completed, which were out of distress situations. So yeah, nearly 7 years with the group now.
Thanks, Russ. So we're just going to work through a set of slides. Briefly, we'll just recap on our strategy, the summary of the first half of the year. We'll spend a little bit of time around the trading highlights. Most of that is concentrated around self-help, given the rather difficult market that we continue to operate within, and some good progress being made there. Russ will talk you through the financial update, and then I'll just conclude with some updates around current trading and the outlook as we go forward. So just play the video, Jake, just for those that don't understand the FLOWTECH business today. We're a specialist company within the world of hydraulics, pneumatics and process equipment, headquartered up in Skelmersdale in the northwest of the UK. But we also have locations across Ireland, across all of the GB, but also across the Benelux. And our goal as a business is very much to keep businesses moving, given that the specialist products that we supply go into virtually all industrial applications that there are, that we see across industry or across off-highway, across utility segments of the market. But not only products. The business acquired a number of companies over a decade ago, and built out actually a wide range of engineering service capability. And so not only do we sell products, but we also provide service and support in terms of maintenance and repair, but also we manufacture systems. Somebody just doesn't want a product, but also wants a hydraulic power unit built. We can do that within our facilities. I'll just keep talking because I can see that the video is being a bit laggard. We also have 40 years experience in delivering major projects, and those major projects can be anything from installation of a hydraulic power unit and system within a bridge infrastructure. And so Tower Bridge is a good example of that, which we got involved in a few years ago, replacing all of the hydraulic power units and pipework on Tower Bridge in London. But equally, we would get involved in some fairly major turnkey projects. One recently with Jaguar Land Rover, where we were helping them in their test facility to be putting in a new hydraulic and energy transfer system there. We are very much focused on technology first, and within that, we're underpinning the business with a digital platform, which I'll come on to in more detail. And we're very excited about the future now that we've consolidated our 17 different brands under the one FLOWTECH brand over the course of the last 12 months. So if we move forward, Jake, and the video, by the way, is on the new website, and so you can go back and watch that. Apologies that we didn't get the feed on that for some reason. In terms of our strategy, really this is about unlocking FLOWTECH's full potential. When I joined the business in April 23, there was a decision really as to whether we wanted to be a house of brands or a branded house. And what I mean by that was that we were operating under 17 different brands across our geographies. And we were very much operating as separate businesses within that, and very limited amount of integration work. And so, for me, I think this business was very much an opportunity to look to see how we could utilize the strength and the power of the FLOWTECH brand, but also how do we combine the full strength of the offering that we have across products, services and projects in order to bring complete turnkey solutions to customers, whether that be a large corporate industrial end user all the way through to a small SME. Equally at the heart of this business, historically and for over 40 years, has been a very, very strong partnership with the indirect channel. So FLOWTECH operating as a master distributor, selling to smaller distributors, and making sure that we're holding the inventory. And within that, we also provide a white label solution for those distributors. And so making sure that we continue to provide that level of partnership is very important to our business. So we set out a strategy under three very simple pillars, putting the customer first. And this was a vision to be able to drive an omni-channel experience. And there's some very, very well-trodden McKinsey research over the last decade that continues with the 1/3 rule. 1/3 of customers want to have a seamless online-only experience. 1/3 of customers want to have a online and experience where they want to interact and talk to people. And actually 1/3 of customers only want to speak to people or send emails and have human interaction. And so the omni-channel experience, when you're a product, a service and a project provider, is really, really important as it links to technical products as a specialist. So we've been working very hard on joining up the dots around our business, bringing that together from a new operating model perspective, but most importantly, thinking about how we underpin what we do with a much more forward-looking, progressive digital platform, which we'll come on to. The power of one is, as I've just described, is about bringing all of our brands under one FLOWTECH, but actually it's about a singular value proposition to market. And we've worked very hard to launch that value proposition to market now and make sure that our customers do understand the full strength of what we have as a business, underpinned by a lean and scalable operating model. And we've done a huge amount of restructuring over the last 24 months to set the business up for scale for the future. And then finally, a world of motion, which is very much our externalized brand strapline as well. We want to be supporting a world to move in what we do, but equally when customers come to FLOWTECH, we want them to access a world of motion. And what that means is not only around hydraulic, pneumatic and process products and services and projects, but actually as we go forward with key macro themes such as sustainability, digitization, electrification, there's a constant stream of new product opportunity and new product evolution that we can add to our portfolio as we go forward. That delivers us a 30 billion European market opportunity to go at, a highly fragmented market. We believe that this business in the midterm can achieve mid-teens EBITDA margins, and that would certainly be our ambition. And we believe that as the market continues to recover, there's no reason why we couldn't be outgrowing the market ×2. Everything we do is data and digitally enabled, and we'll come on to that again because there's been a lot of investment and work done in order to set those platforms up for the future. In order to execute against our strategy framework, we introduced 6 margin growth engines. So our plan in terms of execution of our strategy sits under these 6 headings. And in short, the customer growth is about a consistent and well-executed go-to-market approach, both in terms of sales activity, engineering and service activity, but also the introduction of our digital platforms over time. Commercial excellence is about buying better. It's about selling well. It's about good management and control of gross margin, but also it's about inventory optimization and working capital management and good cash generation. Products and service expansion is not only expanding into new areas, but it's also range filling and where we don't have certain brands, making sure that we have those brands within our portfolio. And again, I'll come on to some successes in the first half where we've been executing against number 3 very, very well. Around about a little under 20 million of our business today is own brand. Own brand was operating as many, many different brands. Previously, we brought that at the end of 2023 and launched in early 2024 a new brand, which is FT Pro, so that we can really start to galvanize around that own brand portfolio. And we've been very pleased with the ongoing growth of our own brand, outperforming the base business in the first half of this year. And operating for less, this is very much about driving efficiency in the operating model, but it's also about making sure that we drive standardization across the business as we integrate and we find ways of doing things once rather than on multiple times. And so having a federated operating model, both from a regional perspective with the right amount of entrepreneurship within region, but also making sure that where we can, we have a group overlay, is really important for future scalability. And that operating model is also important as we think about M&A and being able to quite easily clip new businesses into the platform over time. And then finally, underpinning everything we do, and arguably the most important, is around our people, our talent and our capability. And that's something that we've been working very hard on, both in terms of strengthening our leadership capability, but also right the way through the organisation, upskilling and expanding the capabilities that we have as a business. So that's our strategy and plan on a page. For more details on the execution of those 6 growth margin engines, if you do want to download the presentation pack, there's a slide towards the end in the appendix, which just gives a bit more colour on the 23 to 27 rollout plan as it relates to those 6 growth engines. As an H1 summary, I won't regurgitate what we're going to talk about in much more detail through the coming slides, but really just as a headline, the market hasn't been our friend, and I don't think across industry it's been anybody's friend, and I'll talk to the markets and some data points shortly, but we have been very much doubling down on our self-help initiatives, very much focusing on improving our growth momentum, our gross margins and our operational gearing, and we'll bring that to life through the presentation as we go forward. So let me move on to some trading highlights. We've been very active in the market under our new branding and our new value proposition. This was an exhibition that we attended during Q1, which is called LAMA at the NEC near Birmingham. So this is one of the biggest agricultural exhibitions in the UK market, and we were very proud to be exhibiting there. This is a big market for us in terms of agriculture, as you can appreciate with the products that we supply. And these exhibitions are great for raising our profile, but also for attracting new customers to FLOWTECH. From a self-help point of view, the first point that I would just wanted to call out is that this is really helping us to outperform the market. As we can see on the right-hand side, we haven't seen particularly strong PMIs, and they remain in a position of contracting market. The chart below is UK manufacturing production, which, as you can see, has been very, very bumpy, both through 2024 and also into 2025. As a business, and it's just important to mention this, around about 2/3 of our business is more MRO related, so helping industry to keep moving. If something breaks, we will either replace the product or we might overhaul a system in order to do maintenance, repair and overhaul. And around 1/3 of our business is supplying into original equipment manufacturers. And I would say that 1/3 is certainly more cyclical, albeit all parts of industry have been holding back on the purse and reducing their inventory, but also reducing their expenditure over this period. So we do have a business trend that is linked quite closely to the PMI. And equally, UK manufacturing production, whilst that doesn't go across all industry sectors that we serve, it's a good barometer, and we've certainly been seeing that sort of trend in our business. On the left-hand side, some positives, but also a bit of a reality check, really. We focus and have focused very, very much on customer retention, focusing very much on our top 100 customers and our larger customers, which are very, very strategically important to us in terms of volumes. Within that portfolio, we're seeing some good progress. These make up today around about 30% of our revenue, and of which 65% of those top 100 customers are in a good steady state of growth now, which is an increased velocity on where we were coming through the second half of last year as the market certainly fell away. And I think what's most encouraging, and this is what the chart is representing underneath, when we look at the up traders and the down traders within that, there's far more industry sectors now which are trading up, and we can start to see that there is fewer industry sectors that are trading down, of which on the far right hand side, crushing and screening, which is a big OEM customer base that we have in Northern Ireland, has continued to be quite a difficult market, and whilst there is some signs of recovery there, that is definitely causing us a drag. So overall, we're pleased with the progress. We're making our own success. We're increasing our share of wallet with our existing customers, and the decline is mainly concentrated around specific industry sectors, and that's weighted more towards some larger original equipment manufacturers and some larger projects which potentially are being pushed back as customers are just tightening the purse on cash expenditure. What that does mean, though, is that we have a tail of smaller customers with reduced order value, and that's mixed, in fairness, but broadly speaking, what we can see is a similar order frequency, and there's certainly no issue in terms of customer retention. The order frequency is there, but what we're seeing is a lower order value, which is really reflecting the current market volatility, and as I said, just a holding back on expenditure at the moment. We're very encouraged with the new web platform that we've launched recently, which I'll come on to, and we do believe that improved e-commerce platform will help us over time to increase share of wallet with a broader cohort of customers, and importantly, accelerate new customer acquisition over time, which is not an engine that we've had properly fired up as a business until we've been able to launch this new platform. So just a little bit of backdrop in terms of how we're viewing the market, but mainly around self-help. And building on that story in terms of self-help growth initiatives, we introduced these 4 areas in our full-year results presentation earlier in the year, which are really the areas that we've been doubling down on. And I thought it was useful just to give some updates on our progress in these 4 areas and why that's giving us confidence that we'll be able to have a stronger performance in the second half of the year, both in terms of growth and in terms of EBITDA and cash generation. The first is around the new digital platform, which I'll come on to in some more detail. The second is around product and service expansion. So that's about new product range launches and also continuously evolving our own brand offering to market. Engineering projects, the areas that we provide engineering services and projects, is a key focus for us. And we've actually seen some really good velocity here with lots of new contracts being secured. And that's going to certainly help us as the order book is building into the second half of the year and into 2026. And in organic opportunities, Russell just give us an update on the 3 acquisitions that we've done more recently, and I'll just make a comment in terms of the forward look around that. And I think underpinning that has been an acceptance that the markets have been tough, but there are markets which are showing good signs of growth. And so what we have done in the first half of 2025 is we've very proactively pivoted, not only to continue to drive the partnerships within the indirect channel, but also into segments such as aerospace and defence, infrastructure, which is an important area with good government investment going in to projects both within the UK, but also into the Irish market, and to some degree into the Benelux. Areas such as data centres, where we have a very, very strong portfolio in new builds of data centres and in all aspects of transportation. These are key areas that we've been focusing on, and that's really been helping us to build the order book. So let's just break that down in a little bit more detail. We're delighted to talk to you about the launch of the new digital platform. We talked about this over the course of the last 18 months to 2 years. It's been an ongoing project in the background to get to this point. This is not so simple, actually. The previous web platform was suboptimal. Our customer satisfaction surveys fed back to us very strongly that the existing website or the previous website was not giving our customers what they needed. And so, we had an external assessment done during the end of 2023, and our conclusion was that we needed to rebuild a new platform, and not just the front-end web platform, but some of the back-end technology platforms that underpin that, such as the customer data platform and improving product master data management, so that we can expand and ingest more products. We can update pricing on a more frequent basis without the website having service issues, which was what we were experiencing previously. Just to put it into context, the current website generates around 27% of group revenues today, but we don't have really any marketing effort that's been sitting heavily behind the existing website. That's been very much servicing existing customers, we haven't been firing up performance marketing activity because the website hasn't really been capable of doing that. In the background, we've also built a very strong marketing capability to support the website, and we've worked very strongly with an Austrian partner to build what we believe to be a progressive and very much future-proofed B2B web platform for our customers. Our vision is very much to be the specialist in digitally enabled products and engineering solutions across hydraulics, pneumatics and process, and across that world of motion. And so we wanted to build a platform that we felt we could scale to achieve that. The platforms went live in the UK from August. We did roll out the sites in July in a soft way, and we kept the existing website up and running until middle of August, until we were confident around the cut across, which happened successfully. And we're looking to roll out this web platform into Ireland and the Benelux in the second half of this year. It's worth noting that the new website has material improvements built within it, certainly around site speed, around the whole search experience in being able to find products, display availability and stock information, the right data, technical data sheets. But the overall customer experience, bearing in mind that in B2B, customers have accounts, they want to log in, they want to be able to look at previous purchases, previous baskets. There is nuances in the way that we operate pricing for different customers. It's been very, very important that we've taken time to get that right. And most importantly, underpinning everything has been security and making sure that we have an extremely secure web platform, both for us and also for our customers. We also have created a capability to white label this website. As I said earlier, a good proportion of business that we have within our product distribution arm is servicing distributors and resellers. Historically, we provided them with a paper-based catalogue, which we white label for them, that they take to market. When they place orders on FLOWTECH, we also brand the box and we deliver it as a 3PL logistics service to their end customers. So this is a very, very important and integrated approach. And our customers in that channel have openly been asking for a digital enablement instead of a paper-based catalogue. So we're delighted now to have 4 white label platforms now up and running. They've been very robust. We've had very good feedback, and we'll be looking to roll that out to our distribution partners as an offering over the course of the coming months. And so we're quite excited about that prospect. And then as I said before, we've invested in the background in some of the data platforms. Most importantly around customer data. It's very important that over time we can personalize the customer experience much more, but also we've built AI tools and enablement tools within the platform so that we can start to do that much more effectively going forward. And also on product master data management, we have started to build much better interfaces with our suppliers so that we can start to ingest more products into the assortment. So over time we can materially expand the offering, not just with existing suppliers, but also the onboarding of new suppliers, which we believe will be a key underpin for our growth moving forward. So you can have a look at the website. It's up and running, and hopefully that will also give you more information around the company. You can play the video that I showed earlier. And there's also an investor hub within it down at the bottom. And so please do have a look there, and hopefully that can give you a good access to understand more about FLOWTECH in time. Product and service expansion is another key area of focus. In the first half of this year, we've been strengthening existing strategic supplier relationships as we've been bringing together a centralized procurement and product team to be much more effective in working with our key strategic supply partners, as opposed to each individual business having relationships. Clearly that has benefits in terms of synergy opportunities, and also that leverages the group more, both in terms of the UK, but also looking at our group spend and group leverage with key strategic suppliers. And we also have a very long tail of suppliers, and over time we would also want to consolidate that to be more efficient as we go forward. The 2 supplier agreements that I think are worth a mention, and we've recently published an RNS to announce these. The first is with SMC, arguably one of the world's largest pneumatics and automation OEMs. It's been really important for us to have an agreement with SMC. Actually, the Thorite acquisition and gained access to SMC, and we've been in discussions with SMC, and we're delighted that we're now appointed as the first UK wholesale distributor for SMC, and we'll be looking to be consolidating and helping them to consolidate some of their tail of supply chain into FLOWTECH as we grow our relationship with SMC. And the other relationship is with HPC Kaiser. This is in compressed air systems and solutions, a leading brand. Kaiser is the leading German compressed air brand, high quality. And we had a relationship historically through Thorite Channel. That relationship was stopped around about 3 years ago. We've reignited that relationship, and we're now working up a growth strategy with HPC in order to capitalize on that through the second half of this year, and certainly as we start getting accelerated growth into 2026. And then finally, on our own brand, FT Pro, we've continuously been improving the range. We've got more work to do in this area for sure, but really pleasingly, with the focus we put on this area, with the improvements we've made to product quality, search capability, we're outperforming the base business with also stronger gross margins in that area, and so that's very pleasing to see. On engineering projects, this could be building a hydraulic power unit, all the way up to designing, building, and installing a hydraulic system to move a bridge. The picture on the right-hand side is the narrow water bridge, which is a concept design, which is currently the footings are now in, and this bridge is going to be built during the course of 2025 and across 2026. And this is a good example of what we refer to as wet infrastructure, to do with bridges, flood defences. That could be to do with sluice gates. Anything that's involved in wet infrastructure is typically moved by hydraulics, and this is an area where we have a high degree of specialism. And so we've been working hard in this area where there's a lot of investment going in to secure new contracts. We've got a strong sales pipeline and forward order book. The sales order book, and just to be clear on the order book, this would account for around 60% of our business today in revenue terms. So 60% of our business, broadly speaking, is order book driven, which means that we'll take a bill of materials, or we'll be looking at quoting against a project. There'll be a lead time on that project. We'll typically be either building, or we'll be overhauling or servicing that particular project to completion. So that's around 60% where we track an order book. That order book is more than 25% higher at the end of 2025 compared to the start of 2025. So we're very pleased with the progress there, and we've got good visibility of that order book now going through to the end of 2026 and beyond, actually, in terms of some future projects which we know are coming down the pipe, so to speak. Of note, 2 significant contracts secured in the first half of the year. In fact, 2 bridge projects in Ireland. One is an overhaul of an existing bridge, which is the Edmund Rice Bridge in Waterford, and the other is a narrow water bridge, which is a completely new bridge being built in partnership with BAM Construction and other partners. And both of those projects are commencing in 2025, but also will continue through 2026. 9 million combined euros in those 2 projects alone. And so with that, we've got increased confidence in the self-help growth momentum. We've seen that coming through in Q2, and we expect that to continue through the second half of the year. And again, there's RNS Reach articles to talk a bit more about those bridge contracts if you wanted to take a look. And then finally, just moving on to the inorganic opportunities, and I'll just take a pause and have a sip of tea. And Russ, if you want to just talk through the progress we're making here.
Yeah, thanks, Mike. So just before I come on to the recent acquisition activity, just a pointer to the past, if I may, that world when it was a stable place. The FLOWTECH came to the AIM market in 2014, and in a 4-year period made 15 separate acquisitions. Those 15 acquisitions, I think, were in the region of 60 million of revenue and probably 6 million of EBITDA. So in a stable going concern type environment, we paid about 40 million pounds for 60 million of revenue. I mention that because these 3 acquisitions deliver 18 million of current run rate revenue. Clearly, we're looking to grow that, and we effectively paid nothing for it. To remind you that the Thorite acquisition, which was, again, time flies, that was last August, was acquired out of administration. Allswage was a much smaller business, 2 million revenue, was acquired out of liquidation in March of this year. And Thomas Group whilst it wasn't in an insolvency process, was an element of distress attached to it, and that's a 2 million turnover business, based in a nice new location for us, by the way, in Ashford in Kent. So those three businesses combined, 18 million of inherited revenue. They were all loss-making. I'm very pleased to say that all three of them were very quickly returned to profitability. In the case of Forite and Thomas Group, within 3 months of acquisition. In the case of Allswage, actually, bearing in mind it was in liquidation, within 3 weeks of its acquisition. We didn't pay much at all. Arguably, we paid nothing for these businesses, and that manifested itself in aggregate 3 million or thereabouts of negative goodwill. Now, there's a fairly complicated accounting standard around negative goodwill. Essentially, the 3 million figure represents the fact that we got 3 million more than we paid. And in the case of Thomas Group, the liabilities we adopted in exchange for the assets. There's a question which I've spotted in terms of how are those businesses contributing today. Well, they are all contributing. They're all contributing positively. And, bearing in mind we paid nothing for them, the return on investment is really quite impressive, actually. The return on revenue is single digit in the current year, but I think we set all three of those businesses up fantastically well to be delivering double digit return on revenues, by this time next year, I would like to think. So, really, really strong stories behind all three of those. They bring new locations. Mike's already mentioned some of the link benefits, SMC relationship being a good example of that. So, overall delighted with the progress we're making in all areas.
So just a quick mention that within that, we've added 8 new locations, not just from the acquisitions, but we have added new locations by the acquisitions, but we've also done some work to consolidate existing locations that we had, utilising that expanded footprint. So, for example, we've merged together 2 locations in the West Midlands and created 1 new location, which is a far better place for our employees and our customers to visit and to be part of. And we've also taken 2 locations in Rotterdam, and we've merged those into 1 brand new location as well. So we've done some work to tidy up the estate, so to speak. But being local is important in our business, particularly from a service perspective. But we're really delighted with the work that we've done to continue to run the business more efficiently and effectively, whilst also expanding our geographical reach. And areas like Ashford, which came to us through the acquisition of Thomas, we didn't have any location in the southeast of the UK, and this was strategically important to us. So just a word on that as well, Russ. Thank you.
Yeah, thanks, Mike. So when the market's not your friend, and could argue a fierce enemy in recent times, it's important to do all you can to help yourself. There are 3 charts on this slide. I would suggest that each of them in isolation is quite powerful, and the 3 charts combined, I think, leads the audience to conclude we've done a good job under the self-help banner. The first chart is gross profit percentage. You can see the positive trend there, 39.2% in the most recent half year. That obviously compares very favourably to previous periods. But for us, we often get asked the question, when's that going to get to 40%? Don't know. It might never get to 40%, because fairly obviously for us, it's not about GP percentage. It's about bottom line pound notes, actually. So there's an element of mix that can come into play there. Fairly obviously, if we're getting increasingly involved in big projects such as the Irish bridges that Mike alluded to, there's some clever stuff goes into that, design work, some clever people's labour. So unsurprisingly, the gross margins attached to that are very strong. So, I'd just say our focus is on bottom line net margins and bottom line pound notes. Let's not get carried away with this GP percentage. It's always in our mind, but equally so is making sure we're setting our prices in all areas of our business at a very, very sensible level. And I think some of the progress we've made in recent years have been just stuff that, simply speaking, wasn't being done very well, rather than disturbing the DNA that our customers have experienced within the business for many, many years. The middle chart there Working capital, always important. I mean, I would say that would know with my background. Remember, I dealt in turnaround and distress when often management of working capital made the difference between survival or failure. So I'd draw the audience's attention to the light blue bar and the orange bar, assuming I've not gone colourblind. I think those are the H125 and H124. Where if I strip out, it's obviously important to compare an apple with an apple, but if I strip out the acquisitions, it's an underlying 15% reduction. Put another way, over £5 million of benefit by managing working capital effectively. Admittedly, some of that comes through a lower receivables book when you've got lower revenue levels, but by no means does all of it come through that. You can see that's why I've put stock in particular and trade payables in there as well as receivables. So, a strong and positive story there. Better disciplines nowadays in terms of managing inventory in particular. And the right hand chart there is underlying operating overheads. And recognise we've got this nasty word beginning with I, the inflation word. We necessarily do give modest pay increases in recent times to our people. We've had, like everybody else, to bear the burden of the employer national insurance piece. So to achieve, a reduction in underlying overheads of 0.5 million, I think again points towards the self-help agenda. We have taken some modest number of heads out of the business over the last 12 months. And I think all of that sets ourselves up really nicely for the second half of the year. Obviously, we're deep into that now, certainly deep into Q3. And, Mike's talked about the strength of the order book. I just touched upon the strength and stability of the gross margin. We've got a lower overhead base entering the second half of the year. And, having delivered 3.5 million of underlying EBITDA in the first half, and given our consensus number is 8.4, it obviously points itself to a stronger second half EBITDA period. And for all of those reasons, we're confident in our ability to deliver that. I've already touched on probably the majority of the numbers on this slide. I'll talk briefly around revenue. It's 2.1% up. We think to a degree we deserve to say that, actually, given that, again, we've not paid anything for that incremental revenue. But on a like-for-like basis, it's close to 12% down against a relatively strong comparator in H124. And it's important to say that we're beginning, and beginning is code for June, July and August, have outperformed their prior month comparators. So we're beginning to see some green shoots of recovery. And the reduction there, Mike's already mentioned it, it's down trading sectors, it's down trading customers. Customers haven't run away from us, and we're confident that they will return. And having helped ourselves, we're nicely poised to capitalise on that whenever the recovery comes. It must come at some point. More positively, I guess, the first half of the current year has outperformed a fairly nasty, miserable second half of last year, overall by 5%. I think I've talked enough about gross profit and operating overheads, and I'm going to talk about debt on the very next slide. So I think I'm done with that one. So debt, over a 12-month period, bank debt has increased by 5 million. The chart there is a backwards looking debt bridge, and I'll talk briefly about each of the 2 6-month segments to that. First, for the second half of last year, which is fairly obviously the bit on the left of the chart. We didn't have any EBITDA, sadly, trading cash flow, it says there. But after the costs of restructuring, and remember, we've been doing an element of surgery to improve this business at the same time as making some sensible investment decisions, most obvious example of which is on the new website. But overall, a lack of profitability is the burden that we're currently bearing in many ways in the second half of last year. Obviously, there's some other red blobs there. There's interest and lease payments. There's a capex that I referred to, which will be trending down moving forward. And we did pay a dividend, of course, in the back end of 2024. We're not doing that in 2025. The big green blob there is obviously all of the good stuff around working capital. So there was, in some ways, a modest increase in the second half of last year from 13.5 to 15.1. And coming to the first half of this year, nobody should think that negative red blob for working capital is a bad thing, by the way, because fairly obviously, you've got a natural build of working capital when you swap out a obviously depressed revenue month of December with actually in the current year a really buoyant revenue month in June, actually a really strong performance in June. So don't think that negative blob in working that negative red blob in working capital means we've taken our eye off the ball. In my opinion, it's at least a stronger performance of the big green blob in the previous half year. Good to see EBITDA, trading cash flow, returning. You know, our EBITDA in the first half of this year is virtually 3 times the underlying EBITDA for the second half of last year. So a segue into the what do we think is going to happen in the second half of this year? Well, stronger EBITDA combined with the natural unwind of working capital as we swap out June for December, combined with the fact we've taken the decision not to pay the dividend, combined with the fact that CapEx in particular, now we have launched the website, there'll be some spend on continuous improvement. Of course there will be, but CapEx will be at lower levels going forward than we've incurred in the past. So all those things point towards and substantiate our comment that we're expecting the second half of the year to not only be much stronger in terms of profitability, but much, much stronger in terms of cash generation. 18.5 million, by the way, leaves us with 6.5 million of headroom within our banking facilities.
Thanks, Russ. So just moving on to the trading and outlook, and then we'll move on to questions thereafter. So just in summary then of what we said, very much the focus for the leadership team and for the business in half two remains on the self-help initiatives. And just a summary of those on the right-hand side, clearly we want to capitalise on the investment in the new digital platform. So, you know, over the course of Q3, this is about transferring the customers across, migrating the customers, making sure that we continue to drive steady improvements for existing customers. And as we move into Q4, this is about then starting to trade the new FLOWTECH website in the UK. So ultimately making sure that we're driving upselling, cross-selling activity, and then also rolling out that platform into Ireland and the Benelux markets, which is equally as important in the second half of the year. That sets us up then well for some good momentum into 2026. The forward momentum from the strong sales pipeline and order book is important. You know, we have got a very, very good and healthy order book. We've got some good, strong engineering projects. Fair to say that we've also built a lot more rigor into our project management around these larger projects, so that we want to make sure that we have, you know, far greater confidence that those projects will deliver to the schedules that have been laid out. There is always going to be some degree of risk to any project, for sure, but to the best of our knowledge, we believe that we've got some very solid forecasting in terms of the phasing on those particular projects that we have. We want to be exploiting the new incremental strategic supplier agreements, working in partnership, not just with the 2 suppliers that I mentioned, but across all of our supply partners. And again, the new web platform does offer the opportunity to improve our marketing drive and ultimately drive more traffic in that regard. And there's value creation and the growth momentum from the 3 recently acquired businesses. Remembering that 2 of those in the first half of the year, you know, are still very new to us. You know, they're still embedding, they're still concluding integration, but actually starting to perform very, very well. And Thorite, we've just celebrated the 1-year anniversary of Thorite. And whilst we're pleased with the progress there, we still see huge opportunity for that business to continue to contribute more positively, both through self-help, but also as some of their customers that have been down trading start to recover over time. But very pleasingly, we're on plan in terms of the profitability that we were expecting from those acquisitions. Notwithstanding, and I know that this is a question we'll come on to, you know, we will continue to look at opportunities that the market represents. We're extremely well positioned, and I think our leadership team have proven that we're capable of making good decisions on acquisitions. We've built a model whereby we can quite easily integrate those acquisitions and create really good value. So we're continuously assessing both distressed opportunities, but also good businesses that the market presents right now to us. And clearly that's an ongoing assessment that we're working through. So we'll continue to focus on those self-help growth initiatives. We'll continue to expedite that order book, and the sales pipeline is very healthy. So we've still got opportunity to be driving through into the order book as well. And so from our side, whilst we do see a continually challenging market, and we think that will continue certainly through the second half of the year, for us, this is about driving continued momentum in our top line, based on either business that we've won or business that we can see that we can win. It's about sustaining those improved gross margins that we've worked hard to achieve, but also it's about maintaining that lower cost base as we drive greater efficiency into the operational gearing of the business, and that therefore gives board confidence on the year-end profitability, but also, to Russ's point, the very important cash generation, which due to the second half of last year being weaker, has not been to expectation, and so that's something that we're working very hard on. So I think that leaves us then, Russ, to move on to questions. I've got a number of questions which I've just been jotting down, which have come through. The first was to do with our competitive positioning as an organisation. I'd just say three areas there. We're a specialist trusted brand. We've been in the market now for over 40 years. FLOWTECH is a very, very well-known and trusted brand. So I think that gives us a competitive advantage. We have the ability as a specialist to not only provide products through a high service distribution model, but we can also provide services and manufacturing capability in terms of complete systems. And if customers so choose, we can help them to design, problem solve, build and install and commission complete systems in terms of turnkey projects. And we think that that is a unique differentiator for us. And finally, size and scale matters. This is a very fragmented market. We're actually a very large business in terms of our size and scale. We sit right across the UK, we sit across Ireland, and we sit across the Benelux. That also gives us an opportunity as well to grow further out, and we export to over 30 markets around the world. And we see a big opportunity there for us to continue to drive that competitive advantage of scale into the marketplace. So that's where I would just see us in terms of competitive positioning. On acquisitions, there was a question on the profitability, Russ, of the existing acquisitions. I think you've covered that off in what you said. And I said before, in terms of M&A activity, as we sort of look at this year and ahead, I think I'll say it again, we're very well positioned. We'll continue to review a long pipeline of opportunity. The market, as it is more difficult, is presenting opportunities, but not every opportunity is a good opportunity. We do need to pick the winners, and they won't always be distressed opportunities that we want to explore either. And that's something that we're continuously looking through. But I would just say that our absolute principal focus as we look at the second half of this year is making sure we deliver our organic expectations to market. From a website point of view, there were some questions in there in terms of how do we think that the website is going to drive growth both in the second half of this year, but also as we go forward. I would just say that we've not really built anything into the full year expectation as far as uplift in the new web platform. As I said before, this is about achieving stabilization through Q3, and then we're going to be starting to turn on the marketing engines in terms of cross-selling, driving more traffic, increasing conversion rate, making sure that we're much more active in terms of promotions as we go into Q4. And as I say, we built some great marketing tools within that to give us the capability to do that. I think we're currently 27% of revenue today. There's no reason why we couldn't be looking in the midterm to take that to 40% of our revenue. And bearing in mind, I said that 60% of our business today typically is more order book driven. That might mean that the journey starts on the website, but normally there would need to be some sort of human touch, some sort of consultation or some design work or some offline quotation work. But we do see that the website can be a very, very good tool in order to make sure that our proposition is well understood and it's got a far reach into the marketplace. So we do see this as a midterm growth opportunity and underpin for our business and a key part of our strategy. There's a question as to whether CRM creates us a competitive advantage. Arguably, the customer data platform and the customer relationship management tools that we've built, they are a competitive advantage in a B2B world that is actually still quite laggard as it relates to B2B digital enablement, with some exceptions, I would say. For us, the ability for us to be able to capture good customer intelligence and personalize experience for customers is going to be an increasing competitive advantage, particularly across a multi-generational customer base. It does give us an opportunity to upsell, cross-sell products and services, so not just selling products and alternatives to what they're currently buying or products that are associated, but also, you're buying those products, are you looking to build a system? We can also help you to build a system. And over time, there's opportunities digitally to provide configurator tools and other digital enablers that could also help us to go up that value curve. And as I said before, the omni-channel experience is really at the heart of this. That competitive advantage in an omni-channel is to allow a customer to seamlessly go to the website, come and talk to our people, get technical support, have somebody visit site and assess a particular project, come back to a website. And so we do need to appreciate that this is an opportunity for us to create a great omni-channel, seamless and frictionless experience for our customers, which is something that we're working very hard on. Underpinning that, the master product data, I think, is absolutely another critical enabler, making sure that we can ingest good quality product data, manage that effectively, and present that through the website. And finally, as I mentioned, the AI tools that underpin that. So, if we have a good CRM and a good customer data platform, how do we use AI to better inform us in terms of customers' buying behavior and how we can help them and provide a more seamless experience? So, the website itself is a competitive advantage, and clearly some of those tools that we built behind the website will give us greater intelligence as we go forward. Question around long-term growth ambitions. I think quite simply put, we want to get this business to mid-teens EBITDA margins as soon as we can. We believe that to achieve that, we're going to be north of 150 million in terms of revenue, and we feel that we've got the operational gearing now as it needs to be, and it's all about getting that flywheel for growth moving. Not very much helped by the market right now, but we do believe that the self-help is certainly getting us on the journey, but we've got work to do, certainly as the market recovers, to see if we can get that flywheel moving much quicker. Russ, a question around cyclical exposure. Are we going to be pivoting away from cyclical parts of our business? I think the balance actually is okay. That 2/3, 1/3 I mentioned earlier between maintenance, repair and operational activity and OEM activity, I think is quite sensible given the capability that we have. Just two areas I think that will help to mitigate some cyclicality. One is going to be the website. Clearly, expanding out our customer base more readily and more broadly is going to help us, because that ultimately will drive more traffic and that will de-risk. But also, I would say that the focus around projects and major projects in industry segments that are less cyclical, where there is long-term investment. If I take the Environmental Agency as an example, there's an investment of over 5 billion in the next 5 years in improving UK wet infrastructure and infrastructure full stop. And those are all areas where, if something's being moved of load, then that's going to require the products and services that we can deliver as a company. And so I think that's about us, as I said before, rifle shooting segments of the market where we do see more positive growth opportunity for the future. There was a question about the OEMs such as Parker Hannifin, and I'm sure SMC and others you could put into that bracket. Why do they come to FLOWTECH? Why don't they just go direct to market? In short, they do go direct to market. Typically, anything from 70% to 50% of their business would be direct to market. That's the role of an original equipment manufacturer, but they're looking very much at that top tier customer base where the real volumes sit. They're not as geared up to provide the integration services and the consolidation of multiple products to multiple locations in terms of low order value. And also they're looking for partners in terms of integration projects, whereby it might mean that it's not just a Parker installation, but it might require other product assortments to deliver a complete solution. And that's why, as a specialist, not only as a distributor of products, but also as an integrator of solutions, that's why we're an ideal partner for somebody like Parker, who is a very critical supplier to us and a company that we have an extremely strong relationship with. Is there a risk to project slippage? in terms of some of the bigger projects? There's a question in here. Yes, there is always a risk, and in the current marketplace, I'd say that always continues. But as I said before, all what we do is work very, very closely with the end customer. We'll work very closely around putting in the right schedules, working to their plans in terms of their investment profiles, making sure that we stick to plan, working very hard with our suppliers to make sure that there's no delay in us receiving the products to be able to build systems and solutions. And at this point in time, we feel that we've got a very, very robust forecast in terms of our ability to deliver on those projects in time.
Mike, on that, if I may add, we've announced the 2 big bridge contracts in Ireland, aggregate 9.5 million euros of revenue. When you've got a bridge that's being built to join Northern Ireland to the Republic of Ireland, it's fairly obviously quite high profile, and nobody wants the work to slip. Equally, when you've got a bridge down in the southern part of Ireland, Waterford area, that needs repairing, nobody wants the bridge not functional for too lengthy a period. So there's some points there which would help in the risk of things slipping, and equally the majority of that 9.5 million revenue is not expected to be recognised in the current year. It's 26 and a little bit beyond as well, to be fair.
And then just a question on the order book, the percentages of the order book that we talked to, which is those 2 bridge projects. It's less than 50% of the order book is those bridge projects. So there's still plenty of headroom in the order book, excluding those, as we look forward. Russ, did you want to pick up the question? There was a question on gross margin, and there's a question on net debt. The question on gross margin really relates to, do we think that the gross margin that we've got to is a sustainable gross margin? And what makes us believe that that's the case?
I'm slightly conscious of time. We've actually got close to 30 questions, so forgive us, we will need to address some of these beyond this session. But just picking up on a couple of those, Mike. I think when I was talking through the gross margin slide, I did reference the fact that I don't particularly like the question, when are you going to get to 40% GP percentage, because it's sort of not the point. There's always going to be situations where we need to sacrifice GP percentage for the benefit of our bottom line, and there'll always be a situation where we can enjoy better quality gross margins. It's a balance. It's the art of the relationships with customers. There's a piece around, given what I said about the second half of this year, where will the year-end debt number be? Well, I think, out in the market, we've got numbers in the region of 14 million as a consensus position. And, we'd like to think that we can retain a decent proportion of that EBITDA in a normalised position. We do have interest and lease payments, and we do have CapEx. Of course, we have CapEx, we have maintenance CapEx in any period. But we should be able to retain the majority of that EBITDA should be capable of being turned into positive cash flow and therefore enable debt reduction. So, I think the question says, should we expect to end the year where we started? The answer is, in and around that level, and ideally a little bit lower, actually. There's a piece in there about employer national insurance. Well, both elements of what got announced cost us circa a quarter of the million, aggregate 500,000. No, we didn't pass it on to our customers, was the second half of the question. It just made us work harder to manage our own cost base, to be honest.
And Russ, just on the net debt, there's a point in there that says, based on the projections, would net debt get back to where we were at the start of the year, or the end of the year?
I think I just covered that. And,
okay.
Yes, and ideally a little bit lower was my answer.
Okay. There's a question around, what are our plans for Netherlands and Europe, and what are our thoughts there? It's a really good question. I mean, for us, we've talked quite a bit about the Irish market, and that continues to perform well, with the exception of the crushing and screening industry that I talked about, which is in the north, in Northern Ireland. But in the Benelux today, we have a fantastic business. We've got a great new leadership team in situ. The work we've done in the last 12 months really has been about getting the business set up for success. There's been a huge amount of work to bring 2 very separate businesses into one under one FLOWTECH, but also an amalgamation of inventory. So making sure that we're utilising a distribution hub more effectively in the east of the Netherlands to support the whole of the business, but also making sure that we amalgamate 2 locations in Rotterdam into 1 new location and expand out our offering in terms of our engineering solutions capability. The final sort of piece in the jigsaw really for the Benelux business is the launch of the new web platform, which we'll be looking to roll out in the second half of the year. So that's something which is really important. And then that gives us a nice footing, not only to grow across the Benelux, but also to then start thinking more about European growth. And clearly there's an opportunity there, with that being a smaller proportion of our business today, but Europe being the largest growth opportunity. There's clearly opportunity for us to be able to grow both organically and inorganically in the existing markets of the Netherlands and Belgium, but equally to be looking further afield in time. So I think, Russ, given that we're at 11 o'clock, as you said, there's plenty more questions in there. Just one which I think was important. Are we going to be operating any investor visits through October? Just to say that we typically would look to be opening up a date once a quarter through the year to invite investors and anybody up to come and see the business. That's been something that we're very, very keen on. It's much better for you to come and see for yourself. You can answer some of these questions firsthand, and also you can speak to some of our people and you can hear the journey that we've been on. So those dates will be made readily available via our brokers. And certainly, anybody is welcome to come up and be part of those investor visits. And I'm sure that whether it's October or November, there'll be something in Q4 for people to be able to come and attend. So, Russ, was there anything else that you saw that you wanted to quickly pick up?
No, I mean, forgive us, there are probably about 8 or 9 unanswered questions, but we'll definitely get to those, if not later today, certainly within the next 48, 72 hours. So apologies if we didn't address your particular questions.
Yeah, and again, we've raced through that relatively quickly. So if the answers that we've given aren't sufficient, then do please reach back out. But look, we hope that that's useful. We hope that that's a good update. We're staying very focused on the self-help. We have high confidence that we're on the right track. The performance improvement plan and the strategy we have in place, we believe, is going to take us on a very, very exciting journey towards those mid-teens operating margins. And I think that point around leverage, we're working very hard in the second half of this year to make sure that we readdress the leverage position. So with that, we'd like to thank you all for your time today, and we really appreciate your support and your interest in FLOWTECH. Jake, we'll hand back to you to close down the session, please.
Perfect, guys. That's great. And thank you once again for updating investors this morning. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can really better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of FLOWTECH Fluid Power PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good morning to you all.